Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. We're both financial advisors. We're also fiduciaries. And this is a big one today, Tommy. I mean, this is on a big one that people want to know. How do you save money in taxes during retirement?
We get a lot of these questions. And, while you're working, there's limited options to kind of control your tax situation. You can contribute to your retirement accounts pre-tax, takes that deduction. But while you're in retirement, you have a lot more control, and that's what we'll get into today.
Right, you're exactly right, because when you're working, you have that W-2 income coming in, and so how do you save money in taxes? Well, you just increase the contributions to your 401k plan, which helps, to your point, reduce your taxable income. But now we're retired, we're kind of limited in terms of where we go. So what we need to do is we need to identify your tax buckets.
Yep, and this is a piece of the plan we talk about a lot, but identifying that the income need, the income stream, and then how do we get there through any of the resources people have available.
Let's just quickly walk through those, because what we're going to do today, folks, is this. This is a great episode. I'm excited to talk about this. We all have different income needs during retirement. The question is which lever do you pull to get to that income need in the most tax efficient way possible? Because Tommy, with a lot of our clients, they all say the same thing. We all don't mind paying taxes. We just don't want to pay any more than we have to. So let's start with Social Security in terms of why that's such an important bucket, and then we'll move on to the other ones.
Yeah, for most people, the pension days are, going away or are over.
Basically,
and so, Social Security becomes that fixed income, a large piece of the income plan. And the piece with Social Security, great tax preference.
It is. I love what you usually say. You usually call Social Security one of the best kept secrets. That's usually what you say.
It is.
Because the way it's taxed. So it's all about how it is taxed. So it goes through a provisional income formula. So real quick here, let's give our viewers some real good information and just give them some numbers. Let's pretend that a client is needing money and they're just going to be pulling from Social Security. So why don't you walk us through that?
Yeah, so a married couple filing jointly, they need a round number, $5,000 a month, $60,000 a year. If that is all coming from Social Security, there would be zero taxes owed at the federal level. When they file their tax return, Form 1040, no taxes owed.
Now keep in mind too, there is no state tax on Social Security. We're just dealing with federal. So now with this strategy, this is a couple probably delaying their benefit, or maybe they wanted to continue to work. But this isn't true for everybody in terms of that big Social Security amount. So let's talk about these other buckets. Let's move into the next bucket, the taxable bucket, or what we like to call 1099 now money.
1099 now, yes. So these would be the non-tax qualified accounts. They may be your brokerage accounts, certificates of deposit. You get interest from your bank, maybe know it as individual joint trust accounts, TOD, however you know it. But these are taxed on a transactional basis. So activity in the account creates the tax implications. You have dividend payments, you have interest payments, and then, if you buy something, sell high, the gains become taxable.
Well, right, exactly. So it's kind of like that windshield wiper effect, meaning that when you make money, you pay taxes, you make money, you pay taxes. Even if you're not using the money, you're still being taxed on it. So a good example is, those CDs that you mentioned, you still have to report that as taxable income. And then also the brokerage accounts with the dividends and also the capital gains. So let's keep on those examples. Tommy, walk us through this. So here we got a married couple, and they need $60,000. Now, in the first example, we were showing a couple having $60,000 of Social Security, but now they only have $40,000. They need to get to their $60,000. What does this look like?
Yeah, so maybe a couple took a Social Security benefit earlier, or it's a less portion of their income need. But
Right.
In this case, $40,000 Social Security benefits and $20,000 of qualified dividend income. So an important distinction there, qualified dividends, there is no federal tax liability on that. Again, a zero.
Yes, Tommy, zero federal tax. So even though we have less Social Security, we need that $60,000. So in this case, they're pulling $20,000 out as dividends, and you're still paying no tax.
And
this is huge news.
I know I touched on this, but a quick distinction on the qualified versus ordinary. So make sure the dividends are qualified. Ordinary income is just reportable as income. So interest and ordinary dividends, reportable. Qualified dividends get this tax preference in this example.
I love that. And again, folks, please know this. I mean, we're doing a blanket across a number of things here. It's important that you do talk to a qualified tax specialist about your own individual situation. Our goal is to give you the tools that you need to make these important decisions, because once again, we all have different income needs. And so we're trying to give you those resources, if you would. Right?
Absolutely, yeah. This is definitely a starting point, and questions to bring to whoever you may work with.
Exactly. Now, let's say that $60,000 is not enough. Let's say you need $90,000, and let's stay on this taxable bucket, Tommy. Let's talk about that one.
It ends up at the same result. So maybe delayed or higher Social Security benefits, you're getting into $60,000 of Social Security benefits, $30,000 of qualified dividends. You're still paying zero at the federal level.
That's unbelievable. I mean, $60,000 of Social Security, that's a big Social Security. And then $30,000 of qualified dividends, $90,000, and you pay no tax.
No tax. It's a great deal.
What a deal. Sign me up. This is the stuff we're looking for. I mean, again, folks, that's why we talk about surrounding yourself with a team. Because again, we can't be everything to everybody, so that's why you surround yourself with a tax professional, a financial advisor, and an attorney working together as a team. Because again, I mean, yes, we all have that different income need, but doesn't it make sense to take a different route to get there and be as tax efficient as possible?
Yeah, and a lot of these require planning on the front end. You don't just happen into it. And so that's where you can lay out all your sources of income, all your account types, everything you have, and then work forward from there.
Yep. So we're going to stay on the Social Security and work through the other buckets here. I'm excited to talk about the next one, but we'll do that next, right after the break.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Welcome back. If you just joined us, we are talking about how to become tax efficient during retirement. The question is how do you do that? So what we've been doing is we've been identifying different tax buckets. We just went through two of them. Let's go through the next one, Tommy. This bucket is our tax-deferred bucket, or what we like to call 1099 later money.
So many people will know this as their traditional or their pre-tax IRA, 401k, 457, TSP, whatever line of work they're in. But the pre-tax portion of that and how you accumulate this account most of the time while you're working, we talked about your contribution deduction against income.
To the 401k. Yep.
You put in money pre-tax. You take a deduction against income. It grows for however long it's in the account. And then when it comes out, it is 100% reportable as income.
Because of the way it's structured, I mean, it's nice getting that tax deduction, but this is what can put people in the higher tax tiers, especially during retirement, because it's also subject to the RMD. And we'll talk about that here in just a second.
Yeah, so your IRA, your 401k, typically, maybe the first or second largest asset in a household. You may have your home and then these retirement accounts. And so later, as you are forced to take money out of that, it can create a tax bomb.
It can, absolutely. So let's just pivot and let's talk about the tax code. I love talking about this. So we love talking taxes here. We're a tax firm, right? So anyway, under the tax code, there's different sections of the code. And so this one in particular is Title 26. Under Title 26, there's different sections. For example, the 401k, Title 26, 403b, whatever line of work you're in, you're contributing to some plan. But the one I like talking about is IRA. So what does an IRA stand for? It stands for an individual retirement
account,
right? That's what we all know it as. But under the tax code, that's not what it is. It's actually called an individual retirement arrangement.
We'll let them think who that's with.
I wonder who the arrangement's with. I mean, that's a big piece. But let's just take a look at what is an IRA mainly used for. Usually, it's used for income. Right.
Largest piece of the account, typically
Right to your,
income.
That's right. Right to your point, what you said, the house and also the 401k IRAs. But then the rest of it, we got medical expenses, unplanned, and we also got legacy. So whatever's left, we'll pass on to the kids. But Tommy, if you want more income, which one of those do you think is going to come from?
Love you, kids.
They don't love you that much?
Don't love you that much.
We'll take it from legacy. So, but people forget about the arrangement, meaning it's not all of yours, it's also theirs. I'm gonna have a little fun. Spell theirs. The IRS. I thought that was funny. We'll see if anybody's actually laughing. All right, Tommy. So now that we know that, let's talk about what drives people up into higher tax brackets, and that's that required minimum distribution.
So depending on the size of that IRA and the income need, we've talked about Social Security planning, other sources of income. So depending what you need from that IRA, your withdrawal rate will be determined when you hit required minimum distribution age. If you're polling less than, maybe you're polling 2% or 3%. When you hit that RMD age, most individuals now will be 73, 10 years from now will be 75 or so. In those percentages, starting at those ages, right around 4%. So your first one is a little under 4%, and then it goes up percentage-wise each year. It gets you close to 5% by 80.
It may not be a big deal now because of that percent, but to your point, as we age, that percent goes up. But also, Tommy, your accounts better be growing as well, which means that is what pushes us up into those higher tax tiers during retirement.
Yeah, it becomes a higher percentage of a bigger number, hopefully, if that account's growing.
Right, and so the question is how do I diffuse as much of that as possible in terms of taxation? So we know this is coming. The question is what do you do? So let's give some examples. So this is some really good stuff too. So what we're going to do now is we're going to give our viewers a way to use Social Security and that IRA distribution, because to your point, the pension days are basically over. So Tommy, let's go through this one real quick here. So this couple, there's two couples, they both need $60,000 a year or $5,000 a month. Let's walk through this first example, Tommy, of where they both take their Social Security right away.
Yeah, so early Social Security benefits typically lower. So getting to that $60,000 income need, if they took that benefit early, they have $20,000 Social Security, and they're withdrawing $40,000 from their IRA, $60,000 of income. That results in a federal tax bill of $2,100.
That's not bad.
It's not bad.
It's not bad at all. Think about that, folks. So we have $60,000 coming in, and we have a federal tax bill of $2,193 in this case, zero state tax. Zero state, well, it depends. There's a law there. We'll talk about that here at the end, but that's not bad. Now, let's move on to the next one. A different couple, but they both need $60,000 for income. But in this example, we had where one spouse took their benefit, their Social Security right away at 62, and the other one delayed until full retirement age. Tommy, walk us through this one.
And one quick point on that, maybe they delayed because they had these other sources to draw from. But
true.
Whatever reason, retired later, delayed Social Security filing, they are getting $40,000 in Social Security benefits, just need $20,000 from the IRA to get to that $60,000 number. Zero federal taxes again.
That's not bad.
It's a better deal.
It's a better deal, but what's the message here? The message is this. So two different couples, they both needed that $60,000. The difference is one couple took a different route to get there, and they pay nothing, zero in taxes. That's what we're talking about in terms of how to become tax efficient, how to become tax smart with our withdrawal strategy, because that's what we're doing, folks. We are walking you through each one of these tax buckets, but the question is, which lever do you pull to get to that income need in the most tax efficient way possible?
Yeah, and that's where just the upfront, the pre-planning comes in. And we talked about the Social Security benefits, delaying maybe and getting a bigger benefit. Are you using IRA assets to bridge a gap? Tons of options available. But that's where just the planning becomes so important.
Now, we're talking about married couples. Let's also do a single filer. And so, Tommy, let's walk through this one. So here we got a single filer. Now, keep in mind, folks, married filing jointly versus a single filer, you're just in, those dollar amounts are different in terms of the marginal tax rates. But Tommy, let's walk through this where they need $60,000 as well.
Maybe they were $35,000 in Social Security. To get to that 60, they need $25,000 out of an IRA. Get you to a $2,400 federal tax bill.
That's still not bad.
It's not bad on $60,000 of income.
It's still not bad. I mean, these are some great examples. I really think our viewers and our clients, this is the things that we're looking at. But Tommy, a lot of people may also have questions, about their own retirement, their taxes or whatever. And so that is also why we do this 15-minute retirement review where you can ask us these questions, whether maybe it's on Social Security, or maybe when to file, or maybe taxes, and should I put money into a Roth? Those sort of things. I think it's extremely helpful for our clients and our viewers.
Yeah, plenty of decisions to go through as you kind of near and enter that retirement age. And a lot of topics we can cover on those quick calls.
Right. We do encourage you all to call us if you want our help, but the next topic is a big one. So the next one, we're going to talk about the tax efficiency with a Roth IRA, and we're also going to talk about some tax law changes as well. Stay with us right after the break. Tommy, tell everyone why they need to watch our show.
Because we're helping people get retirement ready, that's why.
It's the Retire Vivid Talk Show.
You don't want to miss it.
Helping you get answers to your retirement questions.
Don't miss him on Retire Vivid, every weekend on ABC.
Welcome back. If you just joined us, there's a lot we just covered right now. You missed a lot. But this one right here is a good one because right now what we're doing is we're identifying the tax buckets is what we're doing. Now, how do we become tax efficient? How do we become tax smart? And one of those buckets is one of our favorite bucket, Tommy, tax preferred.
Tax preferred, or what we like to call 1099 never money.
I love never money.
Never again. And so these are your Roth IRAs or the Roth or after-tax portion of your 401ks,
yep.
403bs,
Yep.
those. So money went in after tax, grows for however long it's in there, and then when a distribution is taken, a qualified distribution is taken, that is not reportable as taxable income.
What you and I see is a lot of clients that come in, they're close. Our clients are retired or close to retirement, and they come in with their 401k plans, and they know it's never been taxed before. They got that tax preference, like we said at the very beginning, throughout all those years. But now it's going, okay, how do I get into this Roth? What's my route in order to get there? And so there's Roth contributions that you can do in terms of getting into this. There's also what we like, and we're going to talk about this, Roth conversions. So this is where we take money from an IRA and then we put it into the Roth. But the question is, Tommy, how much do we do? And how much can we do?
And that's where the importance of tax planning comes in. So part of the retirement plan, we also look at the tax plan as well, not just investments, not just Social Security claiming strategies, factoring in the tax plan and finding the tax efficiencies.
So how do we do that? One way that I like to look at it is, when are taxes on sale for you? What a weird way of looking at it, right?
You're gonna pay them eventually.
All right.
When are they on sale for you?
When are they on sale? Because we just talked about it, the required minimum distribution. So let's talk about this. I'm going to walk through a couple, and in terms of showing you where taxes could potentially be. We do see this a lot, Tommy. So if you take a look, we got the tax brackets. We got the 10, the 12, the 22, 24. That's the marginal tax rates. So in this example, we got a husband and wife. They're both working, and you can see they are in the 22% tax bracket. Then we fast forward. The wife in this example, she retires at 62. So you can see she took her Social Security at 62, but the husband in this case is still working, because what do we all need?
Health insurance.
We all need health insurance. But notice something though. They dropped from the 22% down to the 12%. Then we keep going. Now the husband retired at age 66. Now because of Medicare, 65 is when we get that. They do not have pensions, and so he turned on his Social Security, and they're pulling out from a traditional IRA to meet their overall income needs. But notice, Tommy, they're still in the 12% tax bracket. But then, Tommy, we fast forward to the required minimum distribution.
And we talked about that piece. If the IRA is still growing and a higher percentage each year being required to withdraw. So if that income need is not, basically equivalent to the amount of the RMD, finding when taxes are on sale. So what we look at, if we're currently, we know we're in the 12%, projecting out, we're going to the 22, why not pay taxes now at that lower marginal 12% tax rate? Great benefit.
You hit it, but it sounds so simple. But a lot of people just don't do it. Or maybe the advisor's not licensed to do it. I don't know. But that's what we're looking for. Doesn't it make sense to pay taxes when they're on sale? Because how many times, Tommy, does somebody come in, they go, boy, I wish I met you guys 10 years ago, right?
It happens.
Because of that required minimum distribution. In this example, this couple were good savers, and they weren't pulling out enough, and so that required minimum distribution put them back into the same tax tier when they were working.
And why it's so important to look at, a tax professional to do something like this, that evaluation, the amount of the Roth conversion or in the 12% tax bracket, it's not always a dollar for dollar increase. So we talked about the provisional income formula with Social Security. So as you add, the taxable distributions, the IRA distributions, it's potential for Social Security to become more taxable. So that's why it's so important to work with somebody who can, make sure everything is considered to get you, if you're looking at it, get you to the top of that 12% bracket.
This is big. Now, let's put this with a bow. So we just talked about the buckets. We talked about the Roth. We gave some planning opportunity for everybody as well too. But now let's talk about the law. Let's talk about federal, and then let's talk about state here in Iowa. So Tommy, let's first start with the Secure Act. We had the original Secure Act and then the Secure Act 2.0. Let's just briefly go through that with changes to the IRA.
We talked earlier about the required minimum distributions at certain ages. So the original Secure Act changed the RMD age from 70 and a half for those individuals that turned 70 and a half prior to 2020, moved it back to 72, and then Secure Act 2.0 moved that again to 73. And then moving in 2033, moving to 75. And some numbers in there, but it just allows a longer planning window, typically in between that retirement age to the RMD age.
So that's reason number one, that this is a great time to be looking at this, because they have pushed that back. The reason why we're talking about that, folks, is because of this. The required minimum distribution that you're forced to take, you cannot put that in a Roth. I'm going to be clear on that. So we try to catch people before we hit that required minimum distribution. Next, let's talk about the Tax Cuts and Jobs Act.
Yeah, Tax Cuts and Jobs Act passed or effective in 2017, sunsets for tax year 2026. And what that did is it reduced all levels of marginal income rates and then doubled the standard deduction. So without any changes happening, if it does sunset, you will see marginal rates, tick back up, potential standard deduction decrease,
potentially cut in half. So that there alone, we got 2 good years of this before this may change, and it's all subject to change depending on what Congress does. There's reason number 2. Now let's stay here at home. The state of Iowa, we had House File 2317 that was passed, especially for people that are 55 and older.
Yeah, big retirement income provision in the state of Iowa, and effectively remove taxes on retirement income sources, IRAs, qualified annuities, pensions. Social Security was already not taxable at the state level, but effectively kind of removed tax liability for retirees.
This is why we do this show. We really hope that this information is helpful for you all. I thought we gave a lot of great information today. So again, I hope that there's some nugget that you may be able to use in your own plan. But there's also people, Tommy, that are looking for help. They're saying, hey, you know what? I want to know more about my situation, what makes sense for me, because that's why we're doing this show.
Yeah, we have topic-specific, webinars and also in-person events that they can attend. getting into Social Security, maybe just general retirement planning, estate planning, and Medicare. A lot of questions can be answered in those.
You can also go to Facebook as well too. We encourage you to follow us. We got a lot of great content on there. And also stay with us during the weekends. We're on every weekend giving you information about retirement, helping you get retirement ready. Thanks again for joining us. We'll catch you next time right here on Retire Vivid.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Thanks for watching Retire Vivid. Want to see more? Like and subscribe to our channel to stay up to date with exclusive Vivid content. Plus, be sure to watch our show Retire Vivid every weekend. We're here to help you get retirement ready.